Let me also welcome on board George Alexander Muthoot, the MD at Muthoot Finance, joining in on the show. Good to get in a sense of what's happening about the gold demand outlook. What are the key triggers then for gold loan upcycle? And of course, what kind of AUM growth do they pencil in for FY22? George, good to have you on the show. Gold financiers have currently remained in focus. Help us understand what are the key triggers for the gold loan upcycle that you're currently witnessing.
Gold loan, you see, gold loan upside. Yes, the gold loan offtake is what you should be referring to as the gold loan upside. If the gold loan offtake or the requirement gold loan is generally as a this is a corollary of the requirement of funding in the economy. In the last quarter, all the shops, all our customers, all our shops were closed, and people did not require funding. MSMEs were closed, shops were closed, the small traders were closed, so they did not require funding, and therefore there was very little offtake last quarter. But now in this July, rather by end of June and July, we are seeing more and more shops, businesses opening up. And today, they require financing. Once businesses require financing, any type of loans are in demand. And gold loan being the easiest and the most simplest and the quickest. So they are also in good demand. So we should see good demand going forward in this quarter and the next quarter. We already started seeing that in the last 10 days.
Do underbanked borrowers also see gold loans as relatively cheap a funding source? And what is the kind of yields charged by gold financiers like yours as well as banks? How is the competitive scenario for gold finance NBFCs as well as banks? That's something that we would like to gauge.
Yeah, you said whether gold finance is cheap. To some, it is cheap. To some people, it's not cheap. When they compare it to an unorganized sector, to a local moneylender, etc., it may come cheaper than them. But when you compare it to a bank, definitely it is not cheap. But then people come to NBFCs like Muthoot and others for a gold loan because it is convenient and quick and easy. That is the main consideration. And for as far as a usual gold loan of 50,000 or 1 lakh rupees is concerned, which is the usual AUM of a customer, for them, the actual impact of the difference in gold price is not much. Although the percentage will be higher, but in actual terms, the impact or the extra they have to pay would not be much. So whether it is cheap depends on relatively to who is the borrower and who is the lender. So we should see that a gold loan NBFCs being the first name of recall, people come to them for their gold loan, which is quick and convenient. People go to some others because they see some other USPs there. But for an unorganized player, they work 24/7. They take not only gold, they take something else. For them, it is convenience for that side. But for probably a big customer who already have a bank account, etc., or a bank loan, probably he can think of going to a bank where it is cheap for him. But of course, it may take a little more time than what it takes in an NBFC. So each sector, each player has their USP. So now, relatively, it is relative. Some are quick, some are cheaper, some are, convenient. Those are the factors which affect or which determine the goal. You asked about the yield. For us, the yield generally should be in the range of about 19-20%. But then we look at the interest spread. We just try to keep our interest spread intact. So it comes to about 9 to 10% is the interest spread. We try to keep that intact.
Now, June onwards, we have seen the resumption of activities, and that's led to an increased need for credit. Being a dominant player in southern India, help us understand how demand has been, what the impact of the pandemic has been, and what are some of the consumer trends as well that you've observed?
See, we should see COVID as COVID-1 and COVID-2. COVID-1 was last year. Last year, COVID-1, the first quarter of last year was very difficult. It was all, shops were all closed, businesses were all closed. People did not know what is happening to them. But in Q2 and Q3 of last year, things started opening up. And once it opened up, the business, the credit requirement is so huge, so great, that every business which is doing lending, whether it is gold lending or personal loans or any other loans, also started doing better in the last Q2 and Q3. But of those, because people were little, banks or lending institutions were little reluctant to give on other personal loans and other MSME loans, etc., without collateral, the gold loan was in big demand last year. This year also, we see almost the same trend. The quarter 1 was COVID-2, we should say. COVID-2 came this year. Quarter 1 was very difficult. Many shops were not open, businesses were not open, people were not going out. So overall demand for loans or demand for funding was much lesser. So, but then in the end June and now in July, we see things opening up. The COVID scare also slowly abating. People are moving about, people are going around. Consumption has started picking up. When consumption starts picking up, business demand or demand for funding goes up. And gold loan being convenient, quick, easy, and simple, people prefer that quickly as a loan. But as soon as they get, they're able to get other lending options or other loan options, probably in a SME loan, MSME loan, or probably another loan, education loan or something from the banks, they substitute that with the gold loan they already taken. So first preference or first demand is for gold loan, and that is why we are seeing good demand in this quarter.
You know, in the recent quarter, we did see fairly strong AUM growth of about 5% sequentially. What is the outlook now for FY22? You think it can sustain above 20% plus for the coming 2 years?
Yeah, people have been asking us also to give some guidance on what the growth should be. See, just like last year, this year also, quarter 1 was not good. But we are sure that now that things have started picking up, we will be able to do at least a minimum 15% growth this year also. And that too, mind you, it is on the higher base. The base is also going up every year. Last year, we were able to do much better, but this year, definitely, at least minimum, we'll be able to do a 15% growth this year also. Probably if things are much better, everything is opening up and business credit, etc., is looking good, it can go above 15 also. But 15 is the guidance which you would like to give this year also.
Some of the analysts are forecasting a 21% EPS CAGR and 27% ROEs for you throughout FY24 on an estimated basis. Would you say this is a fair assessment?
No, I wouldn't like to comment on that. I said we would try our best. We are not looking at anything else. We would try our best to do a minimum of 15% AUM growth. All the others are just derivatives of that growth only.
Wanted to also understand, given the movement that one has seen in gold, the fact that year to date it's seen a bit of a dip down, although volatile off late. What is it that you're observing typically when gold prices are rising or falling in terms of consumer behavior?
Okay, thank you. Always the question of the gold price is always there in any interview. So I have to always repeat what I used to say. What is that? Gold prices always fluctuate. You don't say price rise and price fall, etc. It fluctuates. During the year, it always fluctuates. But if you take a 3-year, 4-year horizon, you will see that gold price has only been going up. But sometimes it goes a little faster, but otherwise a little slower. But always it has been going up. During the year, intra-year, you will see in some months price going up, price coming down. These are just fluctuations in gold prices. But here again, oft repeated, what I would like to say is, we don't finance gold. We finance only household ornaments. And that is not really dictated by the fluctuations in gold price. Just because the price has fluctuated, somebody does not abandon his ornament. That is an ornament which family has been, on which he has actually spent money for the making charge also, which is about 15-20%. And we keep a minimum margin of 25%. That is, our LTV is always the today's price, plus 25%. So maximum is 75%. So we have a margin there. We have a cushion on the making charge. And finally, we have the people's sentiment also for their own. So what we have seen is that just because the price fluctuates, people don't abandon their gold. We come to maybe we should go back to the gold and think of monetizing it only when the customer has abandoned the gold. What we have seen is in 6 months, 60% of the customers take back their gold. By a year, 95% of the customers take back the gold. And they are actually, loans are for 1 year plus another 90 days of NPA time. So they have the 15 months time. By that time, 99% of the customers take back their gold. During this period, if there is a fluctuation in price, they did not worry because they have always the 1 year time. We don't have EMI. These gold loans do not have an EMI or a monthly interest commitment. They have a very convenient way. They can pay it any time. They are not. We are not compulsory to pay the interest, etc. So they have such a lot of time in their hands. They don't have the compulsions for making monthly EMIs or monthly interest, etc. If they pay monthly interest, we give them a discount on interest. So some people pay monthly. So these are the risk mitigants we have. And we have seen that over the last several decades of this, we have not lost even 1 rupee because of the gold price fluctuation. Probably, if the gold price falls very fast and while at the time of auctioning the gold price is not high, we may 100% we will recover our principal. But interest instead of 19 or 20%, we may recover only 16, 17, or 15. But that's only on 1% of the portfolio. And that is so little because there is no loan loss, but only some interest reduction, and that too on a very small. So over the years, decades, we have seen that this has stood the test of time.
Your margins held up well at around 14%. Do you think we can look at margins sustaining at the current levels?
Yeah, when we talk about margins, usually I speak about not the interest margin, the interest spread. The interest margin is high. One reason is because we have a more than 25% capital adequacy. That is own fund on which the cost is zero. That is one of the reasons why we have a higher margin. But if you look at the interest spread, it's about 10%. And when our cost of borrowing comes down, we reduce our interest rate to the customers so that we try to maintain our interest spread of 9-10%. We maintain that. If the credit cost comes down by 1%, we generally pass on that benefit to the customer, keeping our interest spread same.